Well, Happy New Year, everybody. This is Ken Winans and Stephanie Larson from Winans Investments. In case you don't recognize me, yes, I do grow a winter beard periodically. And we just thought it'd be great, as we talked about in our last video, to just have a talk with you about where things are now, and certainly we'll give you our thoughts. First off, reports all went out yesterday. We think generally most of you are going to be very pleased with the year-end results. We're actually, Stephanie and I are thrilled. We do believe in seasonality, and you know that November, December run is, even in bad years, I have a tough time remembering the last time we had a bad December. And Stephanie, anything you want to add to that?
No, November actually was a little on the tougher side, but December went great. November was pretty strong on the quarter itself was a very strong quarter. Seasonality was our friend, but the Santa Claus rally, which is typically the last 5 trading days of the year, was just kind of
Yeah.
So it comes in waves.
Yeah, no, needless to say, we were just glad to see that as the reports came out. And,
Yeah.
and certainly everybody here is healthy and doing well and very proud of what the company accomplished. So let's talk about some things that we left on the table last time that I think you should consider. First off, I just recently wrote 2 new Forbes articles that you might all want to go read, particularly the last one, which deals with, the title of it is Bear Hunting, and it's things that investors or professionals in the field need to be watching for to see if there is really a major, bear market coming up. We're not talking about just a little dip in things, but I mean that things do roll over, and as we call a bear market means that it's a long protracted decline, not just not certainly not what happened in 2020 with that panic that immediately came back.
Mm-hmm.
Okay, so a couple other quick things. We're getting people trying themselves to micro-time their changes in their portfolio. I call them knee-jerk asset allocation changes. I encourage you not to do it. Let's do it systematically. If you do in fact want to change your mix of stocks and bonds and preferred stocks and all that, let's do it after we have a meeting to go over your year-end results. Let's look at what your intended objective is in doing it. But believe me, part of what you pay us to do is to have a defensive strategy, and we have a very good strategy for dealing with bear markets. Many of you are watching this had us managing your money back in 2008 and 9. Some of you go way back to the dot-com bubble in 2000 to 2002. So, we know what to do. We have a strategy in place to deal with those really bad situations. So let's keep that in mind. Also, as far as appointments go, you're welcome to come to this office with or without a mask. We keep our distance. We're a little closer than usual, but we're both vaccinated. But you're welcome to come here. Also, I will be traveling in the first quarter around Southern California and Nevada. I'll be traveling around a bit, and I will be seeing clients. So we'd love to see everybody face to face if you're inclined to want to get together. But with that being said, this is a new year. It does have a little bit of the feel like Groundhog Day, that Bill Murray movie back from the 80s, talking about how the day kind of redoes itself. It kind of feels like January all over again. The volatility of January, I do believe it to be true that January does set the tone. Stephanie just did a research piece that she'll talk about in a moment. But let me tell you why January is so important. You have every company, whether they're reporting their year-end numbers or they're giving guidance for this year, going to come out with a statement. It's going to be good, bad, and ugly. Every stock on planet Earth is overpriced right now because of this excessive Fed stimulus that we've had. The money has flowed into the stock market and real estate and other things as well. So that's going to happen. Number 2, State of the Union address. We'll be hearing about what the administration's plans are, and especially with this year being a midterm election. There's going to be a lot of talk there, and unfortunately, there's always a lot of rhetoric during these times of year. So, but it can move markets. Number 3, central bank. We saw a little bit of it yesterday with the Federal Reserve releasing their notes from their December meeting. Every single central bank around the world is going to be talking about things to contain inflation. The UK central bank went ahead and raised rates late last year. We're going to be tightening up the money supply. There's too much of it flowing out there. It's going to begin to tighten up. It doesn't necessarily mean it's all over and sell everything and head for the hills, but what we should get used to, tighter money, higher interest rates, and we'll determine later if it's too late. And like we said, we'll take defensive action if needed. So Stephanie, what would you like to add?
Well, Well, that's a lot of really good points. That's a lot of information. So we'll try to go.
We work hard here every day, so
Sure.
we're always thinking about this stuff.
We'll go step by step. I mean, one of the things to pay attention to is the Fed has been trying to bake in the raising the rates for a while. One can make an argument that the stocks have actually priced them in to a point. Ken's not incorrect that we are woefully overvalued in a lot of ways in the market. But I actually could make the case that the S&P could go up to 5,000. To be honest, I mean, we do kind of expect generally better than expected earnings for the first quarter. Usually that happens after the holidays, just because so much of the industry does well in the fourth quarter. Most of what they bank on is the fourth quarter for sales and things like that. So, with the labor market easing and the money, I mean, the Fed's not going to change its whole policy. It's going to taper, which will change things for sure. So there's a lot of headwinds out there. There's a lot of headwinds, but there are still a lot of tailwinds that we should not discount. But what it means is that what I put in my quarterly commentary this time, which we'll probably send out tomorrow, this is one of the more complicated chessboards that I've seen in a while. There's a lot of things on either end that could really sway the market in either direction. So it just means that we have to really pay attention to what's going on. This is not a buy and hold market. This is not a turn your back on it. This is going to be an actively managed year where Ken's and my portfolio management philosophy will actually work really well, because we will cut what's not working. We will constantly look for what is. And if the market really starts to turn, we'll build cash as needed. But one of the things that actually we've gone a lot about lately is, are you ready? There's a lot of concern out there that the market is so high and overstretched, and they're just waiting for it to implode. Well, what causes that to happen? That trigger is always different. If you go back to all the bear markets or the shock drops or whatever in the past, it's always been something different, right? So what Ken and I do is, and Ken specifically, he's always has all these monitors, and it's not one or two or five. There's screens and there's other layers that go into it, where he and I will talk every day and go, okay, we're getting close to this one. This one's actually triggered. That one's okay. And we kind of go over the whole landscape every day. You're not going to look at 3 bad days in the market and go, oh, set the world on fire, it's finally going. We're going to look for the actual technicals and fundamentals to tell us that it's time to make a move and an adjustment.
Yeah, and I keep in mind that there have been other times when the Federal Reserve has raised interest rates, and it has not brought on a catastrophic bear market. I distinctly remember in 1994 that Alan Greenspan and company started raising rates, and the market did have a mediocre year that year. I think it was maybe up 2%. But 1995, 6, and 7 took off, and we had another leg in that bull market. So there's a lot of things, like Stephanie said, there's an awful lot of headwinds out there that we're paying attention to. At the same time, I think it should be very clear. There's a balance in this company between offense and defense. We are not a buy and hold shop. Many of our competitors, I love it when they tell somebody who is 65 and 70 years old, you're in stocks for the long run. After a run like this, that does not work for somebody nearing retirement. You do have to have a defensive strategy that will involve hedging, that will involve net raising cash. But I would say this, it would have been very easy last year just to buy the S&P 500 and made a lot of money. I do not think that will work well this year. There's going to be individual areas of the market and even companies within an industry that will stand out. A good case in point would be retailers. Mm-hmm. Clearly there were some retailers that did well, like Costco. Had a good Christmas, did well. I can show you a lot of retailers that were who just absolutely got hammered as their seasonal sales came out. Transportation stocks are the same way. We're seeing some companies that are doing real well, and a whole lot that energy costs are really hitting them hard. So it's find those really marquee companies that we will hold on to. But again, even a marquee company can get overpriced. We're noticing a lot of the tech stocks. We have big positions in Microsoft. We're watching it very closely. We will trim back things that we just feel that are taking a pause. Now, I'm aware of taxes. We're aware of all that, but I'm not prepared to start handing back the last 3 years of gains, just strictly for tax policies. So we'll do our best to mitigate that. But Our job here is to manage money and try to hold on to value where we can.
Yeah, and to highlight what Ken was just saying, I also touch on it in my piece. At the end of the year, if you actually looked at the NASDAQ, only 1/3 of the names were actually over their 100 or 200-day moving average. That is incredibly scary, because if you're watching TV, you look at the NASDAQ performance, it hits news highs, everyone's like, oh, everything's great in tech land. It's actually not, because the breadth of the market of what's actually advancing and actually doing well is not good. The actual trajectory for the prices for that sector is actually bearish. So there's a difference between headline news and then what the market is actually doing. And what we're watching is what the market is actually doing.
Yeah, absolutely. Let's talk a bit about bonds and preferred stocks. I think, so let's explain, and that's why the article that we wrote in Forbes called the ABCs of High Inflation. I would encourage anybody who has bond investments with us, or anybody in bonds, should go back and read it. Yet same thing, it's just like when you're picking individual stocks, it's also looking at individual bonds. I have no doubt that bonds that are coming due in 20 and 30 years will have a very difficult time over the next couple of years. I remember reading about the great bond bear market of the 1970s when rates were going up radically. Bonds absolutely got crushed. But the key thing there is not all bonds. The bonds that are shorter term, bonds that are coming due in a couple of years, 2, 3, 4 years, that are paying a high yield, there will be movement in the price. And some of you, even though I tell you don't do it, you do it anyway. Look at your bond portfolios on a daily basis. Do keep in mind bond prices do fluctuate, but it does not have anything to do with what the bond is worth when it comes due. It has to do with if you are going to sell the bond that day. So you have to treat bonds very different than stocks, folks. And I know you've heard me say this over and over again. And if you've forgotten it, I'll go send you another copy of my book on the art of successful income investing. But the days of having bonds pay 6% in interest and you're getting a total return at the end of the year of 8% because the bonds went up in price, I think those days are over. If you're going for 6%, you might at the end of the year get a report that says you're only up 5% because your bonds dropped off a little bit. You're in bonds for cash flow. That's why you have them, and you have them for the certainty of return of what they're worth when they come due. That's it. And so we should all just get used to that and prepared for that. But there will be volatility in prices as the Fed raises rates. Steph, anything you want to add? Or?
No, that's a good point. And I will actually say that the preferred stocks have softened quite a bit in the last 2 months. The reason why is what Ken was saying, is that as rates go up, short-term bond prices or new bonds will actually come to the market with higher yields. So what happens with the longer bonds? Their prices have to go down to compensate for the fact that they don't have higher yields. So preferreds, unfortunately, act kind of like longer bonds. So the preferred prices have softened a little bit, but their qualified dividends are still paying every quarter, and that's what we want them for. So the other thing I was going to mention with the bond prices, Ken's right. You shouldn't look at the portfolios every day. Schwab and TD have to price the bond for us in order to report daily, but that's not actually how the bond prices trade. That's a generality of what they think that bond might be worth. There are days when I can go to the market and I can't find a bond I want, or the spread is so big. You have to think of it kind of like a house. Schwab is pricing your house kind of like Zillow, but what a buyer and a seller actually agree upon are totally different. And what can change the price for me can be who I'm buying it from, how much I'm buying, because that gives the broker-dealer a lot more of a club to hit with, to go, oh, I'm going to buy 1 million shares. I want it at a discount. So there's a lot of other factors that go in to what a bond will actually trade for compared to what Schwab and TD will quote it for.
Absolutely.
Yeah.
Yeah, I know we want to try to keep these under 15 minutes, so let me just bring up administrative things. I know many of you are as frustrated as we are on dealing with the custodians. I know it's easy to beat up on Schwab or TD, but folks, it is throughout the industry. Every custodian is having issues. It's very simple. People are not in an office, they're working at home. And what used to be very quick and efficient because you go over the cubicle and talk to somebody, now you're getting 3 different people on the phone. All I can tell you is that I now know the jingle at Schwab and TD, the holds music, better than anybody. I hear it coming out of, Muzak. I hear it coming from Mindy and Amy's office and Brittany's office all the time.
Yep.
So we're just as you're trying to get things done administratively, please don't shoot the messenger here. We're doing the best we can. We're clearly aware of your frustrations. We know about it. We're having the same issues, which by the way brings up, we are reviewing our options still with custodians. At this point in time, I just talked to the people at Schwab day before yesterday. It does look like the final consolidation is not going to happen until 2023.
Yeah.
So we have some time to figure out what we're going to do here. And I've already expressed our concerns to them about the quality of their service and things. I've been told they're hiring more people and that they're trying to remedy it that way. So, folks, we're here. Call us if you need to go over anything. We thank you for the compliments we've received from many of you. It's always nice to hear that you're satisfied with how things are going. And let's just get through this thing. We hope to see you again soon. And hopefully my New Year's wish is that we get to take the darn mask off soon and leave them off. But I have a feeling that's going to be, it's not down, at least for quite a while.
Well, hey, reach out anytime if anyone wants to discuss their portfolio, have a review. We only ask that we don't do it during market hours, but the doors are open. If you want to come in, we'd love to see you. Amy will be making her rounds around to touch base with everybody. But we're an open book here. Reach out anytime. And also, please get on Tamarack if you're not already. This is where we're going to start sending our videos exclusively, all of our reports. The MailChimp service, which you get in your email, our old way, is going to get slowly phased out over this quarter. So if you're not on Tamarack, you have any questions about it or just navigating, let us know. We'll get you on. But it's really the best way for us to communicate with each other.
Absolutely.
Okay?
And then last but not least, we're expecting to hear from Morningstar in the next month or so, but those medals you see behind here, I think we have more coming, folks. We've knocked the ball out of the park against our competition, and I think we're going to have more 5 stars in our future. So just so you know, we're trying to perform well.
Yeah.
So everybody, Happy New Year.
Happy New Year.
We'll talk to you again real soon. Bye-bye now.
Bye, guys.